Welcome to OpenECRI's Trader Training. My name is Toby Gennaro. What I'll be talking about today is a technical analysis ingredient called indicator convergence. This is one of the critical ingredients utilized in the trending trade strategies that we use in our trading every day. Let's take a look. We measure price momentum by analyzing the price action of the current trend and other factors which give us a lot of confidence that we'll be trading in the direction of the order flow. Now we can get a secondary measure of price momentum by using the indicators, the MACD and the RSI. This is termed indicator momentum. This is exactly what we're trying to do. We're trying to find the most reliable trades, and typically those high probability trades occur when both price momentum and indicator momentum are in agreement. And this term is known as convergence. To get this indicator convergence on our charts, we set up our charting package using the MACD and the RSI indicators. These are just standard indicators that exist on the OEC trading platform. For the MACD and the RSI, we just use the standard settings as they are when you add them to your charts, so you won't need to change anything. But here are the settings in case you want to double check your charts if you happen to be using these already. I've mentioned this before and I'll say it again, we do not use these indicators traditionally. We actually use them in a different way apart from the obvious buy-sell signals that they do generate. Because as many of you know, these signals tend to be lagging in nature, which means they give signals once price has already moved. And that's why it's hard to make money with them. The buy-sell signals are not a very good predictor of future price action. And what we do with them is use them as leading indicators for both convergence and divergence. Let's look at some examples. This is what I'm talking about when I say bearish convergence. I'm saying that as price action makes a new low in this case, so do the MACD and the RSI indicators. So the indicators follow suit with the price. And if you'll notice here on the indicators, there are many times where the indicators go flat. And this is okay, just as long as they don't start going up when price continues lower. And you'll notice this on the RSI as it begins to go flat, and then it dips a bit lower as price also moves lower. The MACD is converging nicely here, consistently making lower lows along with the price, and this is telling us that price is likely to continue lower in the short term. Now if these indicators began making higher lows as price continued lower, then that would be considered divergence, which is what we don't want for our trend following trade strategies. Here's an example of bullish convergence where price is making higher highs and the indicators are following suit. Now in this example you can see that there is no question at all about the convergence on both indicators. They're obviously making higher highs along with the price. So I'm just comparing the extremes in price with the extremes in the indicators. Both should be in alignment and continuing to make higher highs. These indicators are giving us just one more ingredient that we can add to the mix to arrive at a high probability trade setup, and these indicators are saying yes, the trend is very likely to continue higher. So we are continuing to layer on multiple reasons for taking a trade. Multiple ingredients help us to find those supporting reasons when looking for a trade opportunity. Convergence is just one of the several ingredients that we use in a trading strategy to define an optimal chart structure for trading. So if you're interested in learning more about technical trading, check out the OpenECRI website under Education and look for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.